Unprecedented, opportunity, performance. Three words that encapsulate the next section. Unprecedented global demand, opportunity relating to ESG, driving performance in pricing. 2022 will see the return of capital from all corners of the world as travel restrictions continue to ease. We currently estimate there to be £49.3 billion of capital targeting central London. North American investors, who were the most dominant in 2021, will continue to aggressively push core plus and value add strategies. Domestic and European investors are correcting their underexposure to London, and we expect a number of new entrants to enter the market. APAC investment will be led by Singaporean and South Korean investors initially. However, Hong Kong buyers are likely to remain more subdued in the short term. The role of ESG is adding greater complexity to decision making. At a base level, the minimum energy efficiency standards coming in 2030 provide an immediate challenge for reletting. For the estimated 90 to 95% of London offices rated below B, costs to upgrade buildings could be significant. Other benchmarks are increasingly being used by investors to assess ESG performance. We recently mapped over 70 key London investors and found 90% of respondents are currently using global real estate and sustainability benchmarks across their portfolios. And around 30% are using the carbon risk real estate monitors for their analysis and decision making. With only 15% of trades in 2021 regarded as prime, the opportunity for buyers could come from core plus assets with good underlying fundamentals. However, to find value could involve targeting emerging locations and broadening target requirements. Furthermore, JVs and funding opportunities that aim to develop the yield rather than buying the yield will present an expanding route to entering the market. In the value-add space, volumes will steadily increase as owners ill-equipped to meet new regulations start to divest. Smaller lot sizes owned by private capital could be especially prevalent. ESG credentials are now directly feeding into pricing. Finding opportunities to create the right stock will lead to rental and capital value premiums. Knight Frank's Active Capital Research recently looked at how mid-rated BREEAM buildings can achieve 10 to 11% pricing premiums. Our research in Australia for the more familiar Neighbours rated buildings has suggested up to 18% premiums for the very top rated buildings. So, for best in class, the combination of ESG, weight of capital, relative discount to other major cities and expected rental growth has led to prime yields changing to 3.25% in the West End and 3.75% in the city. Whilst interest rates, inflation and COVID are potential headwinds, yields could potentially compress further over the next 18 months. Return hurdles for ESG-focused assets are also lowering. This reflects the reduced risk premium associated with obsolescence, future reletting and liquidity prospects. Accordingly, target IRRs for some investors can be up to 200 basis points below the market norm. On the other hand, tertiary assets will present ever greater liquidity challenges unless pricing accurately reflects future capital expenditure. The gap in pricing to prime assets is only going to widen. So in summary, ESG is leading to both greater challenges and opportunities. Focusing on the latter will drive performance.